Good afternoon, everyone. This is Katie Novotny calling in from Premier Marketing. As always, thank you for taking the time to join us this afternoon. We really appreciate it. Today, we are so excited to have the opportunity to have Stephen Alloy, Maria Rivas, and Amanda Blackburn from Mutual of Omaha. Today, we're going to have Stephen kind of give us some insight on everything that he is seeing on LTC trusts and what he is kind of foreshadowing the LTC arena to do after everything that we went through with Washington. Everybody kind of knows a little bit or maybe a lot of the Washington actions, and now we are starting to see rumblings from some other areas and also some other industry news come up. So with that, we thought no better time than right before year end to inform everyone of what we are hearing and maybe some opportunities. So with that, Stephen, you ready to take it away?
I am. Thanks, Katie, and thanks everybody for joining the call today. Now, in looking at this, you may wonder, since most of you, I'm going to guess, are probably not from the state of Washington. In fact, maybe none of you are from the state of Washington. You may wonder, why are we talking about the Washington Trust Act? Well, reason being, that has become, they were the first shot, I guess, but that has become somewhat of a template for other states that are looking at doing similar things. And a lot of people may think, hey, my state will never do that, but as we're going to talk in a few minutes here, two thoughts on that. Number one, a lot of states that you would think would never do this are actually looking at doing it right now. And number two, really every state has the same Medicaid issue that Washington was dealing with this act, this Trust Act, and they're all looking at some ways to maybe defer some of those expenses, and this is one of the ways to do it. So I think a lot of states are going to, well, already have started, and I think more will continue to follow this model and to do something like this. And some of them are literally exactly like this, but even if it's not exactly like this, I think it'll be basically something similar to this. And so I think a lot of this is going to be coming to your states or states near you, very, very soon. So that's why we're going to take some time with the Washington Act and then talk a little bit about what's happening in some of the other states as well. And there actually are a couple of federal initiatives that probably aren't going anywhere immediately, but again, are probably going somewhere in the next handful of years. So basically, the Washington Act, where the status of it now is, the implementation is on hold until July of next year. It was passed as originally supposed to be fully implemented, fully effective January 1st of this year. But and in fact, employers started collecting the payroll tax with the idea that it was going to start and become fully effective January 1st. Well, later in January, the Washington State House got together and said, I think we forgot a few things with this act. And I would agree. I think, and as you can see, I mean, this is not just the same legislative body. These are literally the same people, the same individuals. There hadn't been an election between the two. These are the same individuals that passed it the year before. They voted 91-6 to say, oh, wait a second, we forgot a few things. So they gave themselves a little more time to get it fixed. I said, hey, return whatever you've collected. We're going to start over again. We're going to start collecting it July 1st of 23. And then I believe the first care date, I have a slide on here. I believe the first care date is January 1st of 2025 would be the first time somebody could go on claims. They kicked that back a little bit. As we'll talk in a minute, they did not extend the time for opting out, however. So those who haven't already opted out can no longer opt out. But the plan is to fix it, and they have made a few fixes to it. But the basic structure of it, I mean, if you're working in the long-term care area, you're probably more familiar with this than you ever wanted to be. But just in case, if somebody isn't familiar with it, it's a long-term care plan. It's designed to really defer some of the Medicaid expenses that Washington and this is why the other states are looking at it too, that they have to come up with to deal with long-term care. So we were talking right before we were getting on here. The long-term care needs, and I think every state legislature is looking at, has these same facts in front of them. You look at the baby boom. The baby boom, the oldest boomers are like 76 now. Just kind of getting into where they're probably going to need care. They're starting those years where care is more likely than maybe it was in the years before. There's another 20 years of baby boomers coming behind that. So is that problem going to get better in the near term? No, it's probably going to continue to be bad. Probably going to get worse actually as the bigger chunks of the baby boom start coming through. So this isn't a problem that's going away anytime real soon. So that's why a lot of states are looking at it. So basically what the Washington plan does is they're going to fund this plan with a payroll tax. So it's going to tax anybody that is a W-2 employee basically in the state of Washington. And that tax now is going to begin July 1st of 23. This website here, wacaresfund.wa.gov, is where you can, if you want to keep track of the deliberations and the changes, and they have periodic meetings that are, I actually listen to one. They are kind of interesting. If you want to keep track of what their thought process is and what some of the changes coming are, that you can do it through that website. So who's subject to this payroll tax using this? And again, this template is being carried over into a lot of other states. Basically, it's anybody 18 or older who's a W-2 employee in the state of Washington. So that, of course, includes residents of Washington who live and work in Washington, but it also includes, residents of Idaho or Oregon who don't live in Washington but work there. If their payroll is in the state of Washington, they're going to be subject to this tax. So the only people really not subject to the tax are the self-employed individuals. So if you're self-employed, if you're a business owner or something, you wouldn't be like sole proprietors, independent contractors, those sorts of things, not subject to it. They can opt in. Now, I haven't heard any numbers on whether any of them have opted in. I did hear that about 400,000, a little over 400,000 opted out of the program. When you think about the population of the state of Washington, which I'm not sure what it is, but 400,000 is a pretty significant number given the population of Washington. So quite a few did opt out. And obviously someone who's retired isn't on a payroll. Obviously they're not going to be taxed on this either. Of course, they won't get any benefits either out of this, but they won't be taxed on it. One of the changes that they've made is they are making some opt-out provisions, extending, I should say, some opt-out provisions just for workers who live out of state but work in Washington, because they realize, that's, unless they move to Washington at some point, they're never going to see any benefits out of this. So they did allow an extended opt-out for them, for military spouses and others who have VA benefits, that they would have other sources of funding for it. Workers on non-immigrant visas, disabled veterans who again would have the VA benefits. So they are extending the opt-out for them, but for everybody else, unfortunately, it is too late. So how much is the tax? Well, it's 0.58 of the wages. So 0.58%. So it doesn't sound like a lot. And if you have a low income, it really isn't all that much, I guess. But you think about it, it's uncapped. So if someone earns 100,000, say in the slide example, they'd pay 580 on the taxes. So if they earn 200,000, they'd pay what would that be? 1,060, or twice 580, whatever. I can't do the math quickly in my head, but so the higher income somebody makes, the higher the tax is going to be. And it's not capped like the Social Security tax is capped. You know, if you can make 20 million, then you don't pay any more Social Security tax than somebody who makes 140,000. But here you would pay a higher, you'd pay a 0.58 of whatever your W-2 wages are. And so somebody with a high income, you look at what they'd be paying in the tax, they could get a private program. They could get a long-term care policy that they could take wherever. They wouldn't have to be in the state of Washington, probably for the same money, probably for less, and it could provide enough benefits. Because we'll talk a minute about the benefits here. But in order to vest in the benefits, and wait till you see what the benefits are if you don't already know, but in order to vest in it, you have to pay the premium tax for either 10 years or 5 or more consecutive years, or 3 years within the last 6 years. You have to work at least 500 hours during each of the 10 years or the 3 years, depending. Which, now in order to qualify, you have to be at least 18, need assistance with 3 of 10 activities of daily living. Now, I'm sure you're all familiar with the 2 of 6 activities of daily living that has always been kind of the long-term care standard. Well, they added 4 more. And so now you have to meet 3 of the 10 activities of daily living. And workers born before 1968, because they started to realize, some of these people maybe won't work 10 years. So, they might work 3 years or 5 years and then retire. So they decided they're prorating the benefits based on, if you were born before 1968, they'll prorate the benefits based on, how many years you've paid in. So you will get something out of it. Big news, you have to be a Washington State resident at time of claim. So let's say somebody, just out of school, they get their first job and they love it and they stay in that job their whole career and they work in that job for 50 years and they pay in this tax for 50 years and then they retire to Arizona. Well, guess what? They get 0 benefits. They get none. They have paid in for 50 years, they get 0 benefits out of this. So that's one of the interesting problems with this bill. So these are the activities of daily living. You can see I put in blue the ones that they've added. They added cognitive impairment, which cognitive, in a way, I mean, we didn't consider that an activity of daily living, but that's always been a trigger for long-term care. So it's not necessarily new, but they added body care, which, I'm not sure exactly what they mean by that, but body care is added. Personal hygiene, I'm not sure really how those two might be different, and medication, not being able to handle your medication. So as long as somebody meets 3 of these 10 and lives in the state of Washington, they can go on claim. So what are the benefits? Well, claim can go on claim as early as January 1st of 25. So some will, there will have been pay-in for a year and a half prior to that. The maximum lifetime benefit, $36,500. So if that doesn't sound like a big pool of money, it's not. The idea was that this would maybe provide a year's worth of care, and that would save the state some money because some people wouldn't need more than a year's worth of care, and they wouldn't have to dip into the Medicaid. But $36,500, I'm not even sure that would provide a year's worth of care. It kind of depends, but you can get that in $100 units. You could actually get more than 100 a day, because the 365 is literally $100 a day over the course of a year, and you can get more than 100 if for approved services, but you can't get more than the 36,500. So if you get more than 100, then you won't get a full year's worth out of it. So not a ton of benefits. And considering, and again, the high income, if somebody has a high income and they're paying that percentage in the tax, you look at what long-term care plan they could buy for those same dollars, it'd be more than $36,500 in most of the cases. So they could probably do a whole lot better on private long-term care. So you may ask, how can somebody avoid this tax? Well, the only way, at least in Washington, the only way to avoid it was if you had a long-term care policy in place, and they included the riders and they included hybrids. So any program, I believe their definition was if it provided at least 1 year's worth of care, because that was kind of the idea with this program, was to provide 1 year's worth of care. So if you had a private program that provided at least a year's worth of care, you could opt out. Problem is, you had to do it by November 1st of last year. So, somebody looking at somebody in Washington now, our underwriters are talented. They're not that talented. They can't get a policy issued November of last year. No longer can do that, unfortunately. So that is something they did not change when they made some of the changes. They have not extended the opt-out period other than for the people with VA benefits and out-of-state people. But somebody living and working in Washington had to have opted out by November 1st of last year. Now you can still file for the exemption until the end of this year, but you have to, in the filing, you'd have to attest that you had long-term care insurance as of November 1st of last year. So once somebody opts out, then they can't get any benefits from the program. So what constitutes long-term care insurance? Well, they really didn't define it in the Act, which to me, that's another thing maybe they want to fix. Maybe they want to put a definition to long-term care. But Washington Revenue Code, elsewhere in the legislation, not part of this Act, but elsewhere, they define it as the long-term care insurance contracts, long-term care riders on a life insurance policy or annuity, or group policies. So basically anything that provides benefits for long-term care would count as long-term care insurance for at least under the Revenue Code and for the opting out. Are there minimum? Does the policy have to have any minimum benefits? Only if they're not specified, but there is kind of an assumption that it would have to at least equal the state law. And I think, as most long-term care policies would be much higher than the state law typically. So if they provide at least the 36.5. Now, one of the problems and one of the things that led to a lot of the carriers basically shutting down the state of Washington was fear of this. What proof is required to show that an individual that opted out and said, look, I have this policy, here's the policy, I've got it as of November 1st of 2021. What's to stop them from paying a year's premium and then lapsing the policy and then never having that coverage and having opted out of this program? What's to stop them? Nothing. There's no follow-up. There's no scheduled, hey, you have to re-opt out, renew your opt-out. No, once you opt out, if you drop the coverage, there's nothing. No way to check. The state hasn't put a way to check. So that was one of the big fears that a lot of the underwriters had. A lot of the carriers, really all the carriers, were thinking, well, we could get a whole bunch of people that take a policy for a year and then lapse it. So that's one of the reasons a lot of the carriers shut down. When does it make sense to opt out? Well, you may think it always makes sense to opt out, and most of the time it probably does. But the people that really are just kind of obvious opt out are the people with discretionary income that can buy good coverage, can buy enough coverage, more than 36.5, that can get private coverage that's portable, that they can take it if they want to retire to some other state, coverage will go with them. I would think to younger individuals who, even if they're not high income at this point, if they might become high or higher income in the future, they might eventually figure out, I'll be paying more in this tax over the years than I would in this long-term care policy. Why don't I just do that? Certainly anybody who is thinking, Washington's a great state to work in, but I don't want to live here when I retire. If you're not going to live there when you retire, yeah, you definitely want to opt out because you're not going to get anything for it. And probably the most obvious one, anybody that thinks 36.5 maybe isn't the benefit that they really want, and they want more flexibility, they are great for opting out too. So you might think, well, all right, so who wouldn't opt out? Well, somebody who is low income and relatively close to retirement, but at least would have maybe the 10 years that they have to pay in. Somebody who's low income and is likely to stay low income, I don't know, maybe this would work. I don't know that they could get a decent policy for less than, the tax would be. This would be better than nothing for them. Well, it's only a little, I think it's only a little better than nothing, but it would be better than nothing for somebody that's going to continually be low income. And certainly those who are nearing retirement would vest in the program. This might be, depending on their income, if they have a very high income, they could still do better probably with private long-term care. But, if they have kind of a moderate income and they're nearing retirement, maybe, as long as they realize that they would be able to vest in it. So maybe everybody doesn't opt out, but I think most people, it probably does make sense to opt out. And obviously, yeah, you could add to this, they would have to intend to stay in Washington their entire lives, because otherwise it wouldn't even work for these people. So what happened as a result of this in 2021? What happened to the long-term care market? Well, carriers basically halted sale in the state of Washington. Lapse rate, and as we've talked about, and then just the capacity to handle the volume was another concern. So now we've all come back. I can't guarantee that the others have. I know Mutual has. I assume all the others have come back as well in the state of Washington. But I think that's kind of like the forewarned is forearmed. If this starts to happen in another state that has maybe a higher population, as we'll show you in a minute, a lot of the states looking at this have a much higher population than the state of Washington. So talking literally the most populated states in the country are looking at this. And I got to think, if we had a problem with the state of Washington, once a state like New York starts to do this, yeah, well, we're going to shut down day one probably. So it would have to already be in place. So what states are considering similar legislation? This isn't even a complete list. I've learned I got to amend this slide. It seems like I'm amending the slide every week or two. There are other states that are considering it, but this is just a small example of some of the states that are looking at it. I put Pennsylvania in red because they actually put a bill. They have a bill pending. A lot of these states have a bill pending, and some have, not likely passage. Some have more likely passage. The Pennsylvania bill probably isn't going to pass, at least this year. But interesting thing about it, it basically is exactly the Washington state law, but they were going to start their payroll tax. The bill was introduced, I want to say in like August or September, or first part of September of this year, not very long ago, and they were going to start the payroll tax January 1st, as we become effective January 1st of the next year. So what that meant is anybody that wanted to opt out basically had to get the coverage in place between, say, September 1st and January 1st. A state with the population of Pennsylvania, we couldn't have even done that for a small state, let alone state with that kind of population. So that would be, I think most carriers would not be able to do that. So if somebody wanted to opt out, didn't have it in place, they probably wouldn't be able to get it in time to opt out. Another state on here, I'll talk about a couple of these other states, because a lot of them are very similar. Some of them are in very early stages, but New York has a bill pending that you know, it's always difficult to handicap what's going to happen in politics, because I'm sure if you think back a few years, you probably can come up with some things you never thought would happen, and they happened. So hard to say, but New York has a bill pending that would the opt-out you would have to have had the long-term care coverage in place by January 1st of whatever year the bill passes. You know, so if that bill passes this year, and I think most people think, well, low likelihood this year, but next year they think is a decent chance. But if it passes this year, well, you know, you're already too late to opt out, because you would have had to have it in place by January 1st of this year, which, you know, again, our underwriters are talented. They're not that talented. So if it passes sometime next year, coverage would have to be in place by January 1st of 23. California, who I think most of us thought would be the next state, is actually taking a slower and more deliberate look at this. They have they've set up a commission, a task force that's going to put a report to the governor and the legislature by January 1st. It might be a little bit before that. I doubt that it's going to be much before that. They've had quite a few meetings as well, and it's, as you can imagine, there's a lot to consider with all this. So somewhere around January 1st of next year, they're going to come up with a plan that, you know, depending, probably has a pretty good chance of passage, and probably would pass, I would think, next year maybe. So I don't think they're going to do anything this year, because I don't think they're going to shortcut the process they've already started. But I think if they come up with a plan, I think it's got a decent chance of passage next year. So on the federal level, there are actually a couple of initiatives, but probably the best known one is the WISH Act. You know, they love these acronyms. It's the Well-Being Insurance for Seniors to Be at Home Act. It was introduced in July by you know, a New York congressman. Payroll tax of 0.3% paid by employee and 0.3% by the employer. So it's basically set up almost like the Social Security tax, except it's a different number. But you notice that you put those two together, you've got 0.6, which is darn close to 0.58. Very similar model. Full benefits after 40 quarters, which again, that's sort of the Social Security, and that's 10 years too, if you think about it. So that's very similar to the Washington one, but that's also kind of the Social Security model as well. Beneficiaries here have to have reached, unlike the Washington one, would have to have reached Social Security full retirement age, is what FRA. So for most people who aren't already at full retirement age, that's 66 and change or 67. So would not be able to go on benefits prior to that time. And the benefits are going to be, they haven't set a lifetime maximum, to be based on income history. So again, they're kind of merging the Washington and the Social Security into a federal act. I'm less focused on this, because I don't know if you guys are familiar with govtrack.us. It's a website, a source that follows legislation, and they almost give, it's almost like a handicapper here. They almost give like odds on this bill passing. You see prognosis, they give a 3% chance of this bill being enacted. So pretty unlikely. And, you know, you look at what's going on in Congress. Yeah, I think this is pretty unlikely to get passed. But nonetheless, I mean, that's pretty unlikely right now. As another session of Congress, you know, takes over next year, who knows? Or 2025, there'd be another session of Congress, who knows? One of these days, there might be a bill that does pass. This probably won't be it, or at least it won't be it this year, but who knows down the road. So what does all this mean for long-term care insurance? Well, this just, I'm going to go through this kind of quickly, because this kind of recaps that basically everybody got swamped with state of Washington policies and applications after that law passed, and everybody shut down. So One of the thoughts that's going on that a lot of carriers, including Mutual of Omaha, are looking at is, well, as this starts to roll out into other states, maybe we need to create a product that has a longer elimination period, or something kind of almost like a Medicare supplement that would cover long-term care that wasn't covered by the state program. So there might be one with a one-year elimination period or something like that, or just catastrophic policies that would go beyond, the basic stuff that these acts would cover. So, yeah, that remains to be seen, I guess, what comes of this. This is still very in the very early design stages, but there probably will be some product adjustments, product design changes, or new products really that will come out in response to these laws, as assuming that multiple states go in. If Washington is the only state that ever does this, probably not. But I think most people think they're not going to be the only state that ever does this. So they're looking at what they could roll out in states where this happens. So what's the best way to approach clients? And hopefully with this, I'm not giving you the impression, I don't want to give you the impression that the sky is falling, that it's like a fire sale, a panic. It's not, because like I say, a lot of these aren't going to necessarily pass immediately, but the sky's not falling, but it is starting to get pretty cloudy, and the wind is picking up, to keep that storm analogy going. I think we've got a little bit of time, the next handful of years in most states, to get the story out, the long-term care story out, and have an audience that might be motivated to really listen to it. Because the long-term care story has always made sense. So it makes sense, but it always did. But now I think we've got a situation where you can say, this story makes sense, and instead of saying, yeah, I should do that someday, it's like, no, you might want to do that now, because if the state law passes next year, you might already be too late. You might have to have this in place before that law passes. So, you might want to look at this sooner rather than later. So, as the states are looking at this, and there might be another federal initiative. Once those actually pass, when they set an opt-out date, that creates rushed planning, and that ultimately, certainly that's not good in the carrier's end, because most of us can't handle the volume that would come in, especially from some of these more populated states, New York, California. Some of these states would be devastating to the underwriting areas. But it also creates rush planning at the client end, where they may say, yeah, just give me something, and it might not really be what they need, or what's really going to work for them. It's just something. It's enough to opt out. Well, great, but wouldn't it be better if you take this time, this next handful of years, to really design the program that's going to work for them best? And also, of course, this has always been true, prices increase as you age. So, if you are thinking, well, I'll do that someday, it's like, well, you can do it next year, but it might cost you more, and might be too late to opt out, depending on what state you're in. What about a non-working spouse who, this plan, they don't have spousal benefits with the Washington State Act, and most of these state acts do not cover a non-working spouse. So what do you do? Well, you got a non-working spouse. We have great spousal coverage, but these acts don't, unfortunately. So that you really need the private coverage. And also private long-term care, it lets you get the right benefit amount, lets you set your own elimination period rather than one that you're handed, one that you're given. Plus, mutual, and I know a lot of other carriers do too, but I know we have care coordinators that can actually help you. If you need care, if you're going on claim, they can help you find the right place. A place that's going to work for you, and place that the benefits would cover, or would at least mostly cover. provide inflation protection. Washington might index that 36.5 to inflation. I don't think they've quite decided. That should, to me, that sounds like one of the fixes that they should work on. They haven't quite done that yet, but that's out there that they might do that. But again, you can decide your own inflation protection with the private LTC. You can also get a cash benefit, which is not available in these state plans, not to mention the spousal protection and the discounts that come with that. So a lot of good reasons to consider private long-term care. Probably biggest of all, some of these things we've already talked about. It's portable. You don't have to live in any particular state. You can, you want to retire somewhere else, go retire somewhere else, take your policy with you. They have long-term care there too. Go take the policy, use the benefits in whatever state you live in. Higher wage earners are going to be able to get, real coverage, more than just the 36.5. They can get real coverage is going to work for them for maybe the same dollars, maybe lower, depending on what their income is. They might be paying more in the payroll tax than they would to a really good long-term care plan. And not to mention, rather than paying a tax, wouldn't you rather get a tax credit or a tax deduction? Well, private long-term care can do that for you. It gives you, on the federal level, you get the tax deduction. A lot of states have tax credits. So I don't know if anyone on the call sells long-term care in New York, but I know New York has a pretty good long-term stat on their state income tax. They have a pretty good tax credit for long-term care. And that's a state that I wouldn't wait real long to start talking to people in New York in case that passes next year sometime. And what a great story that would be. Not only get the plan that's right for you, but also now you can get tax credits and federal deductions rather than paying a tax. So a lot of good reasons to consider private long-term care. And I really think that with a lot of these state laws in the works and kind of moving forward, as I say, it's not like the building's not on fire right now, but I think we've got a window of the next few years before most states really enact things like these types of laws. I really think we may look back on the next, 4 or 5 years as the golden age of long-term care sales, because you've got a good story and you've got people that either they're already motivated because they've read what's going on, or once they find out what's going on, they'll say, well, I don't want to do that. It's like, well, you do have an alternative. Here's your alternative, is to get your own coverage. You can opt out of the program and you can, you live wherever you want to live and you can still use the coverage. So I really think we're coming into the next handful of years that could be outstanding for long-term care. So with that, I just want to give a quick commercial about our advanced markets department. We do a lot of different things. We work on both long-term care and life, and on annuities for that matter too. So we can help with individual concerns. We can also help with business planning solutions if you work with business clients. We do all these business concepts. We also will do business valuations if somebody's looking for the value of their business, particularly for a buy sell or for any of these strategies. And last but not least, I wanted to talk about something that our long-term care area has created that I think is just a great opportunity to get the long-term care story in front of people at a time where, boy, if there was ever a time to get the story in front of people, this next handful of years is it. We've created this flyer that it can help get that long-term care idea in front of it. The links in here are client-approved videos. You can see the links here in the middle under choose the correct version, and the modified for certain states. But those are client-approved videos. They're short, but they'll get the idea in front of the client. And so then the client can see it, and then you can follow up with the client, or they may call you and say, yeah, that makes a lot of sense. But, tell me more about it. It's a great way to kick off, to get the idea in front of them, or to kick off if you're doing a long-term care seminar. You can show the video. You could show it if you're doing a Zoom meeting or even a face-to-face meeting. You can show it as the beginning of the meeting. You can attach it to an email. Say, oh, hey, thanks for setting the appointment. By the way, 2.5-minute video, 3-minute video. Take a look at this, and we'll talk more when we meet. So great way to generate interest. And we've had a lot of success. A lot of producers have really done well with this, and some of them I know have put the like a link to this in the signature line of their email. So when they are just sending an email for any purpose, they have that link in there. So somebody clicks on it and, oh, look at this. Hey, long-term care, that makes sense. So I don't know, just something that our long-term care area created that I think, and it also really helps. It can help really with any sale, but it's designed primarily for long-term care. But if somebody sees this, they say, hey, that reminds me, I need to get some life insurance for XYZ purpose. Okay, well, might help with that too, but certainly is primarily designed for long-term care, but can really generate a lot of other ideas as well. So, and again, this is our advanced markets team. We weren't on camera today, but that's me there, second from the left. So certainly, if you have any questions, certainly you can start with with your marketing organization, and then certainly you can call our long-term care people too as well. But feel free to call us too if you have any questions on some of these state laws or on the taxation. Most of the questions we tend to get are on taxation of long-term care or some of the state provisions, but certainly we're glad to help you with whatever we can. And with that, I don't know if anybody has any questions, but I'd be glad to maybe take some questions here if we got a little bit of time.
Perfect. Thanks so much, Stephen. This was great. I really appreciate it. A couple questions did come in. One is regarding, do you happen to know how this would affect any military personnel, specifically what happened in Washington?
Mm-hmm. I would think. Since Washington is sort of the the canary in the coal mine, for one of a better analogy. I think a lot of states are looking at what Washington is doing. So I would think most states would probably do the same thing same thing that they did with the change. Not that they did originally, where they didn't exclude it, but I think most states probably would say, well, look, they're going to have VA benefits, so that's different. They're not really a Medicaid risk for us, so we can exclude them. I would think, but again, kind of like we were saying, I hate to predict what's going to happen in politics because I've been wrong before. So,
another question is do you know of any states that have specifically pointed out any type of, I'm guessing the way this is phrased, they mean that they're going to give them a certain period of time, an opt-out period?
I would think. Well, Washington did originally. They passed the law in, gosh, what was it, May or April or May, I think, of 2021, and they gave until November of last year. So I think most states are probably going to do that. New York one, like I say, is a little bit different. That you have had to have had it the year by January 1st of the year, whatever year it passes. So that's not giving you time from here. That's like, well, you should have already done this sort of thing. So I don't know. Other states may take that role. I would think most will probably do the give you a little bit of time. But again, once the law passes, carriers may not be able to handle it. If we got swamped with, we and everybody else, not just us, if the whole industry couldn't handle the state of Washington, I shudder to think if we had to handle the state of California, in 3 months, 6 months, it'd be, well, we'd shut down day one probably. So it would effectively be too late. So I wouldn't necessarily wait for that time period to get the coverage in place.
Perfect. Another question that was typed in is regarding Have you ever seen this proposal to be effective on anyone that is not a W-2 employee?
Um,
So I think what the question is that are you seeing anything that gives us any inkling that we're going to see this branch out beyond that, maybe to business owners, anyone else?
yeah, that's a good question. I guess short answer is so far no, because most of the models have been based on a payroll tax, and in fact, in using the Washington as an example, they let self-employed or business owners opt in. I haven't heard that I've heard that very many did, but that was an option to opt in. That's an interesting question. I wonder about that if at some point the funding isn't enough, then will they say, hey, we're going to modify this and we're going to add, we're going to make this part of an overall income tax. We're going to add 0.58% to the income tax, and we're going to take it from there, which would really impact everybody. I don't know. That remains to be seen. Those haven't gone out yet as proposals that I'm aware of, but I mean, it certainly is always a possibility that they could shift to that. And if this proves to be not enough funding, which it's not a lot of benefits, so it might be enough funding, but I got to think ultimately it probably won't be enough funding, so they may switch to something else. So that's always a possibility.
Interesting. Well, perfect. Well, I think we've covered everything. I know that was quite a bit of information. Stephen, I can't thank you enough. I know that you and I had conversations prior to this, and continuation of conversations, I guess, is how we're going to have to put it, because this is a moving target. But I do appreciate your insight on this specifically. All the examples you gave us, and also for everybody out there that joined us today. I cannot thank you enough. This was something that we wanted to bring to you. As you can kind of see, this is a constant moving target in our industry, but it is something that we want to stay ahead of as much as we possibly can. And if there's any questions that you have, I see a couple people saying that there are going to be recordings coming out. So there's a couple people typing in right now. So we are going to send out the recording. And then if any of you have questions, please feel free to give us a call at Premier. We're happy to help. If we don't know the answer, I am sure Stephen would be happy to get on a phone call with us and we could run through something.
Oh, yeah. Oh, absolutely. Yeah, be glad to.
So with that, again, thank you everyone for your time. Stephen, thank you so much for all the insight. We really appreciate it.
Oh, thank you. Thanks, everybody.
Have a great afternoon, guys. Thanks.
All right. Thanks.